Hey everyone, welcome back to the channel and thanks so much for being here today. If you've been following my content, you know that I'm constantly on the hunt for overlooked opportunities in industries that are undergoing massive transformation. Today, I want to share something that's been capturing my attention extensively. I've been analyzing the advertising and marketing services sector, and I've uncovered three absolutely compelling opportunities that are all trading under $1 per share. Now, I know what you're thinking. Advertising agencies sound mature, boring, and like they're being disrupted by everything from AI to digital platforms. But here's what most investors don't realize. Within the advertising sector, there are specific companies addressing emerging markets and consumer segments with differentiated services and real commercial traction. These aren't failed traditional agencies. These are legitimate companies operating in emerging advertising niches with real revenue, real products, and real potential. The reason they're trading at these ultra depressed levels has nothing to do with the viability of their business models and everything to do with market conditions, scale challenges, and the fact that microcap advertising companies often get completely overlooked by institutional investors. Today, I'm going to break down each of these three companies, explain what makes their advertising services valuable, and most importantly, explain why I believe they represent exceptional risk reward opportunities for investors who understand emerging advertising trends. So stick with me as we explore three under $1 advertising opportunities that could potentially deliver significant returns. Let me start by explaining why sub-dollar advertising and marketing companies can represent compelling opportunities right now. The advertising industry is massive, with hundreds of billions spent annually across traditional media, digital platforms, and experiential marketing. However, the industry is also highly fragmented. There are thousands of advertising agencies operating at different scales, targeting different industries, and serving different geographic markets. What's particularly interesting is that emerging advertising niches like experiential events, digital marketing for emerging markets, and specialized brand focused services are growing faster than traditional advertising. The three companies I'm about to share all operate in these emerging niches with differentiated positioning. Each has legitimate revenue and commercial traction. Each is trading at valuations that reflect extreme pessimism that could be corrected dramatically if the companies achieve modest growth milestones. Our first opportunity is a diversified marketing services provider offering brand centric solutions to consumer packaged goods manufacturers and retailers across North America, Asia Pacific, and Europe. Trading at approximately $1.15 per share, this company has experienced a dramatic decline from a 52-week high of $3.76. The company is absolutely massive in scale with $3.57 billion in annual revenue. Think about that. This isn't a micro-cap shell company. This is a multi-billion-dollar services platform that operates in three major segments: branded services, experiential services, and retailer services. The company offers brokerage services to consumer goods manufacturers, analytical services including retailer research, in-store merchandising, omni-channel marketing, supply chain and logistics services, and private brand strategy execution. The company is ranked as the ninth largest agency company in North America and 18th worldwide. What's absolutely critical to understand is that despite the stock's decline, the company is actively working on transformation initiatives designed to streamline operations and improve profitability. The company maintains substantial relationships with major consumer goods brands and retailers globally. Most importantly, analysts maintain strong buy ratings with price targets around $2.50, representing approximately 117% potential upside from current levels. For investors who understand that this company is a real business with real scale that has temporarily fallen out of favor, this represents a genuine value opportunity. Our second opportunity is an integrated digital marketing solutions provider specializing in metaverse stimulation, virtual reality and augmented reality design, creative event planning, IP character creation, and social media marketing services. Trading at approximately 95 cents per share, this company has experienced extreme volatility with a 52-week high of $6.88 and a low of 36 cents. The company is headquartered in Hong Kong and serves customers across Asia and beyond. The company reported 2024 revenue of $2.76 million with earnings of $379,000, demonstrating a profitable operating model. Most importantly, the company is positioned at the absolute forefront of emerging advertising trends. Metaverse marketing, virtual reality experiences, and augmented reality campaigns are becoming increasingly important to brands attempting to differentiate themselves and engage consumers in new ways. The company is providing services that virtually no other mid-sized agency is offering at scale. Additionally, the company is expanding its service offerings and acquiring complementary capabilities. The company has a market cap of approximately $24 to $28 million, suggesting minimal market recognition, despite profitable operations and positioning in emerging advertising technology. For investors who believe in the growth of immersive marketing experiences and see value in an undervalued company with profitable operations positioned in emerging technology, this represents a compelling opportunity. Our third opportunity is a Hong Kong based event management service provider specializing in themed experience events, IP licensing, trade shows, conferences, concerts, exhibitions, and brand promotion events. Trading at approximately 40 cents per share, this company completed its IPO just in July 2025 at $4 per share. The company has experienced dramatic decline, revealing significant challenges with customer acquisition and event demand. However, the company recently secured an $18 million equity purchase agreement with Hudson Global Ventures, providing crucial capital to fund operations and growth initiatives. This is a material development, suggesting institutional recognition of value. The company has only 12 employees and operates in the event management space, which is absolutely booming as consumers increasingly seek experiential marketing opportunities. The company specializes in themed experience events using IP licenses from animated cartoons and theatrical motion pictures. This is exactly the kind of differentiated service that commands premium pricing. The company is also expanding its service offerings to include ticketing platform development and strategic acquisitions. Most importantly, the company secured significant capital just weeks ago, indicating there's institutional belief in the business model. For investors who believe in the event and experiential marketing trend and see value in a freshly capitalized company with unique IP partnerships, this represents a speculative but potentially rewarding opportunity. What ties all three of these advertising opportunities together is that they represent companies in different stages of maturity, but all trading at valuations reflecting market pessimism. The first company is a multi-billion-dollar platform temporarily out of favor. The second company is a profitable emerging tech advertising firm with minimal valuation. The third company just secured institutional capital, suggesting confidence in execution. In each case, if the market recognizes value or the companies execute their strategies, the upside potential from these depressed levels could be substantial. However, I absolutely must address the severe risks involved because these are genuinely speculative investments. The first company is facing challenging market conditions and transformation execution risks. Profitability improvement isn't guaranteed. The second company generates minimal revenue, and scaling operations to meaningful scale is uncertain. Customer acquisition and advertising is expensive and competitive. The third company is extremely early stage with high cash burn and execution risk. IPO lockup expirations and dilution are concerns. All three stocks could continue declining. You could lose your entire investment. These are not for conservative investors. Position sizing is absolutely critical. Never allocate more than a small percentage of your portfolio to any single sub-dollar advertising stock. These should represent only opportunistic positions. Do extensive research, understand the business models, read SEC filings, know the customer bases. Don't invest based on my recommendation alone. Use this as a starting point for your own investigation. Have ironclad discipline around entry and exit points. Know exactly when you'll take profits and when you'll cut losses. If this analysis interests you and you want to explore further, I encourage you to research these companies thoroughly. Dive into the SEC filings, understand the service offerings, form your own independent conclusions. I would love to hear your thoughts in the comments. Do you think any of these sub-dollar advertising companies represent opportunities? Let me know. If you found this valuable, please smash that like button and subscribe. It helps tremendously. Thanks for watching. Remember, the best investment is the one you understand completely. Do your research, invest with extreme discipline, and never risk money you can't afford to lose. I'll see you in the next video.